Welcome to this week's live strategy session. Thanks for joining me. Terrific having you with me for another show. And what a show today! So much to talk about. Big movements in the equity markets. Some of the commodity markets going in the opposite direction. So we've got things to talk about there too. And of course, any stock codes you'd like me to have a look at, get those ready. We'll go through those at the end of the show and get a technical idea on what could be happening there. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's jump straight into our charts for the week. And our first chart is, of course, the ASX 200. And this has been one of the ASX 200's most extreme swings in the last decade. It's just finishing its fourth consecutive week of selling, and it's now about 10% below the all-time high from mid last month, so about this time last month. And the last time we saw such a sharp reversal from an all-time high, it was back in January 2022. And there's this point here, you can see this, January 2022. That's the last time we saw that sort of sharp decline. Back then it fell 11.9% in around 4 weeks before we then saw that strong rebound. And prior to that, the other time we'd seen such a swift reversal was, of course, during the COVID crash, where things really tumbled over probably a 6 to 7 week period. So this type of reversal that we're currently seeing in the ASX 200, it doesn't come along that often, maybe a couple of times a decade. So the question now is, should we be preparing for a larger unraveling, or is this simply a nasty shakeout that's maybe nearing an end? I've got a fascinating indicator that I want to show you. And what it does, I think it really helps frame the sell-off and then hopefully helps you deal with the current situation and, of course, managing risk going forward. But before we get to that, let's just start with this latest sell-off. And so last week we spoke about the significance of support that comes in around 7,900. You can see this blue horizontal band on the chart. That was a notable support resistance region last year. You can see like various times interacted with that support resistance region. But this time around, it's been of little help at all. Nor was the previous support that came in at around 8,100. That didn't do a great deal to halt this decline either. And this has really been an aggressive sell-off, and one that hasn't really been able to find any support the entire way down. I think when we look at this, and this is something we've discussed over the last couple of weeks, and that is the hesitation of investors to step up and buy this dip. Rather, it's been a case that even the slightest rebound through this period has quickly been sold. So having seen these two support levels not do very much, like what's next? What's the next level to keep an eye on? And the next level, I think, really is this big support zone that comes in at around 7,600. Now, let me just compress this and show you why this is of significance. What it does, it takes in a series of highs from 2021 and 2022, as well as some considerable technical activity from 2023 through to last year. And you'll also see that it includes 2 panic lows from last year, the first one being in April, the second one being in August. And so this is the most significant support level so far. Since the high, this is a big one. This is the major support. It's only about, if you see where the market is now, it's only about 1.5% below where prices currently are. So I think this is the support that will. So what we're going to ask now, like, is this the support that will finally lead to a meaningful rebound? And I want to show you an indicator that I think gives us some key insights to like how this support could play out. What I'm going to do, so we've got the ASX 200 here. I'm going to switch to a chart of the All Ordinaries. And the reason I'm doing that is because the All Ordinaries has a greater history of data than the ASX 200. They're so highly correlated. It's almost like looking at the same thing, slight differences, but we've got that longer history with the All Ords. So let's jump over to that now. So this is the All Ordinaries, and you can see it looks pretty similar to that ASX 200. And what I want to focus on this indicator down the bottom. So what this indicator is showing, it shows how far the All Ordinaries is from its 50-day moving average. So it measures the percentage difference both above or below the moving average. And so this can be quite helpful to use when we're going to look back at some past data. And at the moment, it's around 6%. So it's about 6% below the 50-day moving average. So the 50-day moving average is a red line up on top, and it's 100-day below that. But we're focusing on the 50-day. So where the 50-day average is at the moment, the All Ords is trading around 6% beneath the average. And you can see that on the indicator down here below. Now, I've run a marker. You can see this blue line beneath the indicator. That just references 6%. So we can see how this has been significant over time. And as you'll see, I'll just scroll back quickly so you can see, you'll see how 6% often marks an extreme. So I'm just going to compress this right up. It goes all the way back to 1980. And just watch how we get these extremes. They tend to come back to around this average. You can go through slower. You can pause it if you want, or you can call it up yourself if you can get the average. But I'm just giving you this quick overview. Then we'll dial back on some of the areas. We're back in the 1990s now. You can go back further. You can still see 6%. It keeps coming up at these extremes into the 80s. Here's the 87 crash. Well, we get these extremes of extremes that indicators don't mean too much, but they're very rare events. Well, rare is rare, not very rare, but they're just, you don't get too many 87 crashes. And then, going all the way back to the beginning of the data, you can see how this 6% region has been of significance. Now, let's just quickly go back to current day. So, yes, you would have noticed there are a few overshoots. You can see an overshoot just here where the cursor is in 2022. So, yes, there are a few overshoots, but generally, it's rare for the All Ords to be stretched more than 6%, or at least much more. Rare for it to be stretched much more below 6% from its 50-day moving average. Now, when you go back and analyse all that data that I quickly just scrolled through them, there are two general types of sell-offs that result in this condition of the price being 6% below the moving average. And so two types of condition. So there's the first is the capitulation sell-off. And this often comes near the end of a multi-month correction. Like here's an example here from 2022. So this was the highs were back in 21, and then we had this multi-month correction, and you can see it reached those a bit of an overshoot through 6%, but nonetheless it was at the tail end of a multi-month correction period. And the other situation, and of course that's not what we have at the moment, because this isn't the tail end of a multi-month correction period. This is a 4-week decline. And then we've got the other type of situation. And the other situation occurs when there's a panic sell-off from a market high. And that happens when prices quickly move from above moving averages to below moving averages, and then becoming stretched below the 50-day moving average. An example of that is just here in 2022. So you can see the market, it was All Ordinaries hit an all-time high in January 22, and then over a 4-week period, it quickly declined. It was about a 10% decline, not dissimilar to what we have now. It was a quick decline. You can see the indicator came back down to that just a little bit of an overshoot through 6%, and then we had the rebound. And this is what often happens when we get these quick reversals from all-time highs. The market then tends to stabilise, before we get stabilized, before we get a strong rebound. And I think that's what we could be seeing in current day. Like, I don't know, but I suspect this is a sort of scenario we could currently be seeing. So I won't go through all these examples. As you saw, we could scroll back to 1980. There's too many of them. But let's just find a couple of interesting ones, and I'll highlight instances of a quick reversal from an all-time high, and we'll see what's happened. So because we're using an all-time high as a marker, I've got to go back a fair way because we've got this big high here in 2007. So the first example we're going to look at is here in July 2007. So what happened? We've got a false break. There's a consolidation. There's a false break, and then the market quickly comes back over a 4-week period. It declined about 15%. So there's a 4-week 15% reversal from an all-time high. What was happening then? It was credit concerns and oil prices hitting record levels, up over $100. Spooked the market, and we got that quick reversal. Look where our indicator is. It's down here. It got below 6%, but thereabouts. It's down around there, and then we get the strong rebound. Now, if you know your history, I know that was just prior to the GFC, and things really started to fall apart afterwards. So yes, there was trouble ahead, but this is about what often happens after a panic sell-off. The actual top that involved structural change with moving averages. That's a topic for another time. What we're focused on here is panic sell-offs and how the market often responds when it's stretched below the 50-day moving average. Let's go back and find another example. Another one is I've highlighted here so I could find it quickly. So this is 2000. This is the dot-com bust, and again, all-time high for the market. Goes through a quick sell-off. Again, about 4 weeks, 12% sell-off from above the moving average to below the moving averages. Hits this 6% sort of region, thereabouts. Then we get a strong rebound back towards the averages. Same thing happened over here in 88. This is the Asian financial crisis. Again, from above to below the averages, down here at this 6% point. This was a 13% sell-off in about 4 weeks. Now, what's interesting with the Asian financial crisis is, yes, there's a strong rebound, doesn't go on to make new all-time highs. Instead, it then proceeds down to lower levels, gets oversold again. So this is just another possibility to consider. We can see strong recoveries that don't go to new all-time highs, but do relieve an oversold situation before more corrective activity plays out. So I'm not suggesting any of this is easy by any stretch. There's all sorts of variations that can happen. So it never is easy. It's not simple. But there is a lot of history to suggest that quick reversals from above the 50-day moving average to around 6% below the 50-day moving average often lead to strong rebounds. Let's bring this back to present day. Now, there are always going to be exceptions. So I can find all these examples where I can say, hey, look, this worked. But of course, there's always going to be exceptions where it doesn't work. And a prime example of that is the COVID decline. So have we been working on that theory in COVID times? There's 6%. And you can see prices just got stretched and kept going. There are no guarantees the market will do anything. And of course, what we're seeing in current times could be, there could be another exception. We'll look back and go, that was an exception. But I prefer to go with odds rather than trying to predict exceptions, because I don't know where the exceptions are going to be. And I think the odds favour that what we're experiencing at the moment, I think the odds favour this is an ugly shakeout, just like some of those examples we've seen in the past. And even if this does ultimately turn into a larger decline, like it did in 2022, we had the ugly shakeout, we had the big rebound, and then we had the structural change and the bearish conditions came in. So even if it did turn out like that, I think the odds favour a strong rebound back towards back towards the moving averages to relieve what appears to be an extremely oversold situation. And if price action then warrants it, well, then that rebound could provide another opportunity to reduce risk. I don't know. We need to see what the rebound looks like when it ultimately comes. So should you panic or should you stick to your plan? I think, in my mind at least, there's no question about it. Sticking to a good plan leads to the best outcomes over time. So whereas you go out there and people panic and they quickly go, look, this is just awful. I can't take it anymore. I'm going to cash. This is ridiculous. They do that, and often it ends in disappointment. So I don't know how this will play out. Maybe this gets a whole heap worse, and people say, geez, I'm glad I went to cash when I did because it got a whole lot worse. But we've been through history. We've seen how things often play out. So that's where I tend to favour how our past examples have worked out. And panicking often doesn't lead to the best outcomes. Sticking to a process, in my experience, typically does. So there could still be some shaking. There could still be some shaking of the tree to come, and there's no guarantee the selling won't get worse, as I've just said. But I think a good plan accounts for that possibility as well, because a good plan is going to have an exit strategy that will get out of stocks if they continue to come off. I think it's a case of staying cautiously calm and sticking to your plan. I'm happy to be holding extra cash, as I've been telling you over the last few weeks. I've actually have been like selling stocks. I've been de-risking over the last few weeks. I'm happy to be holding that extra cash, and I'm not in a hurry to try and pick the low. Whilst I think there could be that rebound coming, I don't want to try and pick the low because we just don't know. I'd rather stick to a plan, exit when I need to exit, and be cautiously calm as we go forward. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Helps heaps. Tell YouTube you're watching. YouTube shows other people. That's a big deal for me. So please do those things. Now, let's jump over to the US market and see what's been going on there. And of course, quite a lot has been going on there. So I'm going to start today with the Nasdaq. I've got a chart of the Nasdaq here, and you might have noticed I've got a different moving average rather than my usual 50 and 100-day moving averages. I've got a 200-day average on the Nasdaq, and the reason for that is because a record run, well, a near record run, has come to an end. And that record run is the Nasdaq last week closed below its 200-day moving average to end the second longest stretch in history above the 200-day moving average. And we're talking on a closing basis, so don't worry about the intraday low you can see there. So yeah, this move you can see from 2023 through to current day. That's the second longest run in history. If you're wondering, and you probably are, what's the longest? Well, that was back here in 2016 to 2018. It was not much longer, but a bit longer than what we've currently had. Now, so what does that mean? What's this breaking of the 200-day moving average mean? What it doesn't mean that a big bear market is inevitable. The 200-day moving average, it isn't a special threshold that automatically leads to lower levels. What it does tell us, though, it tells us that a whole lot of technical damage has been done in the last few weeks, and it further weakens the chart structure. Ever since we had this false break, we spoke about this a few weeks ago, this false break in the Nasdaq, false break in the S&P 500, there's been little interest in buying this dip. And that's what's allowed the Nasdaq to quickly make its way below the 200-day moving average. If we go over to the S&P 500, so I've got the regular averages here, the 50 and the 100-day moving averages. We have a look at this. These averages are now close to crossing, and it looks like it's almost inevitable that they will cross. And that creates the condition for an ongoing decline. Now, just because the condition for an ongoing decline is present, it doesn't mean that it will happen. I think the key now is what does the next rally look like? A strong rally back above the moving averages, which we have seen in the past and is a possibility. If we got a strong rally back above the moving averages, it then disengages the sell cycle. And if we see on the other hand, if we don't get that strong rally back above the averages, and instead we get a muted bounce which sort of slowly grinds its way back below the averages, well then that opens the risk of a larger ongoing decline as it creates that vulnerable chart structure that we often talk about. It was interesting to see through the week. So through the week, I saw the latest AAI report. Now that stands for the American Association of Individual Investors. So that came out through the week, and bearish sentiment had its seventh highest reading since the survey began. And so that's a sign that extreme pessimism is coming in, and it helps explain why we're not seeing any of these dips bought, because pessimism is just so high. Now that doesn't signal a low, because pessimism can get more pessimistic. It's the seventh highest, so clearly there's higher readings of pessimism. But nonetheless, it's these are the conditions where notable lows or strong rebounds often do form. As I pointed out last week, this currently isn't a global sell-off. So when we look across Europe, for instance, or we look across Asia, even parts of South America, some of the other emerging markets, a lot of these markets are in positive territory. I'll show you an example. This is the German index, the DAX. So here's an all-time high. It was at an all-time high just last week. It's pulled back % or two, not very much. So, and this is what we're seeing in a number of other markets. So this sell-off largely remains based around US mega caps and small caps. They're the ones which have been hit hardest in this sell down. And of course, the ASX is being caught up in the volatility. A lot of the rest of the world has not been caught up in the volatility to this point. Maybe it changes, but not yet. So coming back to the S&P 500 quickly, my focus here is on protecting capital. So I've cut my exposure to the US market, and it's now protecting capital. So maybe we'll get a multi-month period of messy price action where conditions just get harder. We go through those times do happen. For me, that means holding more cash and knowing where my exits are for the positions I still hold. And I still have plenty of long exposure in the ASX. So this is where those wide trailing stops I so often talk about come in. And this is my plan for protecting capital and making sure that I'm ready when the next round of opportunities ultimately do return, because we know they will return. We just don't know when they'll return. The key is having the capital and having the mental will to take them, because you haven't been beaten up and smashed around too much in the sell-off, especially through not having a plan. That makes it even more harder to step back into the ring later on when those conditions do improve. Okay, so I'm going to jump over to US small caps now. Then we've got the local small caps, the commodities, all the stock codes you want me to go through, we'll get into. But of course, that wraps up the free section. So if you're not a strategy session member, there's a link below. Click that, come in, costs you very little, and hopefully you're going to get a whole heap of value for basically the cup of coffee money we're talking about for coming in. And so think about doing that. All right, so let's go over. Let's start by going over to the Russell, the US small caps.